Hi everybody, and welcome to this review of the trading week ahead by CMC Markets. My name's Rick Spooner. Well, this is one of those weeks when there's not a lot of data due on the economic calendar. So it is one of those weeks, I think, where trading ranges could be important for traders. One of those weeks where markets perhaps oscillate a bit between value points without a lot happening to really change the big picture outlook. And so what I thought might be useful for traders this week is to begin this week's review by just a look at both the Australia 200 and the Aussie dollar markets, both of which are setting up potentially useful trading ranges. The Australia 200 index is now making higher highs and higher lows, and it's doing so after bouncing out of this 78.6% Fibonacci retracement zone of the last major rally. The other interesting thing, I think, is that 78.6% retracement has taken an ABC, three-part swing formation, and that often indicates the end of a correction. So that, I think, for technical traders does create a bit of a bias towards ongoing upside from here. The potential could be, in fact, that we might actually break up above the resistance, which I think is around the previous high at 5808, and go on to resume the uptrend with a break eventually above 5840. For traders with that persuasion, that suggests that any pullbacks we see this week, any weakness that comes back towards this support at 5859 could be a buying opportunity. And the background of that as well for the Australia 200 index is that we are heading into the end of the financial year on Friday, and it's not uncommon to see a bit of window dressing, if you like, and last minute buying to support the index at the end of the financial year. One thing to be aware of, though, from a chart point of view, it seems to me from a negative perspective, would be that if we did rally up towards this resistance and perhaps stopped at the resistance or thereabouts, or at the 78.6% retracement of the move down, that's in that 5802, 5810 zone. If we stopped there and begin to fall away, that would be an indication of potential weakness. Turning then to the Aussie dollar, I think we've got a fairly well-established support now, with previous peaks and the recent lows at just above 75 cents, at 75.15 cents or thereabouts. And the other thing is that we've got the peak from a week and a half or so ago around 76.36. If we were to rally up towards, or even right up to that peak, that resistance at 76.36, and begin to fall away, that would really confirm a trading range, and that would have the look of a distribution pattern, I think, for those who followed our theory, a sideways movement that sits at the end, top of an upward rally, and that in turn is a sign of potential weakness. So that, together with the fact that the slow stochastic in the box below the chart has dropped out of the overbought zone, is now trending downwards. I think any failure back up at this resistance, if we rallied up towards there and failed again around about that 76.30 level, that could represent a selling opportunity, looking for a return possibly to the support just above 75 cents, but even potentially for a break below that support for a resumption of the deeper downtrend in the Aussie dollar. Now, one of the key world markets, I think, at the moment is the oil market. It, as I'm sure everyone is well aware, has dropped sharply in recent weeks. I think from memory, down around 16% in the US oil price over recent weeks. Now, that means that I think a key swing market for mood, if it was to continue dropping from here, that would generally be taken as a negative for the commodity complex and potentially for the Australian markets, both Aussie dollar and index, because it would be saying something about the overall weakness of commodity markets. But it has stopped falling in recent days at what could be an interesting technical level, and I'm planning to do a separate blog on that in the next day or two. What this means, I think, is that for Australian markets in particular, but all world markets generally, one of the key data sets this week will be the US weekly oil data, and particularly their inventory and production data. The market definitely wants to see oil inventories continuing to fall now. They fell 2.5 million barrels last week, and so oil could be very sensitive in either direction if this inventory and production data misses expectations. Either way, either it's not good or much better than expected. So that data will be released just after midnight, early on Thursday morning Australian time, around about 12:30. The other key world data, I think, comes late in the week. At 11 o'clock or thereabouts on Friday Australian time, we've got a release of China's PMI, manufacturing PMI index. Now that's been running at rates of moderate expansion, just above 50 at 51.2 for last month. I'd say the market is generally expecting things to be about the same as that, but the market will be very sensitive to this on two counts. The first is that the market, MARKIT version of this PMI index was weaker than expected last month, and that flew in the face a little bit of improved exports and solid industrial production data in China. And so again, given the fact that commodities have been falling and just stabilised a bit recently, I think the Australian markets in particular are going to be very sensitive to this. Possibly the most market moving outcome would be if this data is better than expected and shows an improvement. I think that could really feed into the support we've seen in commodity prices over recent days and be very helpful for the Aussie dollar and Australia 200 index. Another potentially market moving data set this week, I think, will be the US personal consumption and income data. Now that's due for release at about 10:30 Australian time on Friday night. Now the background to this is that we saw a nice rebound in spending in the US in March and April after very weak data during the winter in January and February, which had been weather-related weakness. Now the market is hoping for a reasonable continuation of that, as you can see, looking for a 0.2% increase in consumption. But again, I think if that's weaker than expected, then given the recent weakness in the US dollar and low bond prices, we could see that trend towards dollar weak continue if this data misses to the downside. Another important part of this data as well is the core PCE data. Now this is a measure of inflation, and the market is going to be very sensitive to this, I think. This is the Fed's preferred measure of inflation. There's a real debate going on between the markets and the Fed, if you like, at the moment, with the Fed continuing to indicate that it proposes just to keep going at a fairly regular pattern with its interest rate tightening, and also beginning to sell bonds as to unwind its QE program. The market, or many in the market, clearly believe that inflation is going to be too weak to really allow them continue to do that at a regular rate as we move into 2018, and so as a consequence of that, we've got US bonds still very weak, with the 10-year bond around 2.15% and the US dollar weakening recently. So here again, I think the risk is to the downside. If this inflation data was to really underperform, that would tend to really fuel that market position against the Fed. So as you can see, the year-on-year read last month was 1.5%. I think a general expectation may be that it would be a bit lower again this month at 1.4%, but anything weaker than that could be quite bearish for the US dollar.